Hello everyone, welcome to Offsetter 24/7. My name is Niharika Wale Bhatnagar and I am with you with the area of accounting and financial management for bankers. First of all, happy Lodi, happy Bihu, and happy Pongal, everyone. On the eve of these multiple festivities going on, we have started with our sale. That means our official sale is on, where you can get double validity on all our Mahapacks as well as 80% discount on all our courses. So if you're planning to purchase any of these things, then it's high time you should do it right away because the sale is there for a very limited period of time. So if you're planning to do this, then please go ahead and check it out on our website or in our app for further details. Along with this, if you find my sessions useful, if these sessions had been helping you out in terms of the studies and all, then what you can do is please go ahead and like the session and share it among your peers because when you are there to motivate me in terms of my teaching and the work that I'm doing right now, that really brings up another level of spirit that keeps us going in this particular field of YouTube and working and teaching. So just a little step of yours is definitely very valuable. Okay, now what are we doing till now? Module C. We have reached the module C, another chapter that is calculation of YTM. Another very, very important chapter. I think from the last three classes, you would have been hearing this particular term from me a lot, and you would have been thinking ki almost every chapter, ma'am is saying ki this is very important, this is very important. What exactly is very important, isn't it? Overall, I call the entire module C very important because module C is something which is normally asked in the examination a lot. This was earlier a part of module A of the previous syllabus. Once the new syllabus was introduced, this was a part of new syllabus. Okay, so that's a part of the new syllabus right now. So this is again a very important area. So I think if I have to tell you ratios plus interest and annuities. वैसे तो ratios is something which always comes in the form of case studies. Then we have this chapter by TM. Then we have Forex. Up to even derivatives is there. This is a new chapter which they have introduced. I believe these are one of the most important practical chapters for you, right? Forex and YTM. These are good in terms of the questions. The questions are quite tricky as well as the content is definitely very interesting. Why? Because now there are practical based theory questions that can come from the area of YTM, at least that I feel. So today I'm going to give you an insight of all those kind of questions. In the upcoming class, I'll discuss the numerical portion of it, of course, so that you can get a view of what kind of questions exactly comes from the area of YTM. Acha, so this is the entire era of module C, which I personally feel is very, very important. And I'm sharing all those important questions as well. I think I'll start with a few more questions where I'll add up once we are done with the entire series now. I'll start discussing questions which have been asked in the previous year as well. All these questions that you are currently getting is directly taken from the IIBF book. I prepare those questions, I share it with you. So if you're planning to continue to stay with me, then what you can do is stay tuned. Once the entire sessions are over, then I'll add up the next point of it and then I'll continue it that way. Ki every single time that we are having a class, I'll keep on adding more and more set of questions for you, right? Okay, now here comes the first question, everyone. Acha, we have talked about debt and equity. Debt is what? Debt is the money that I take from others. That's something that we call as the loans taken from others. And equity is what? Equity is something which we call the uh, the owner's funds. है ना? This is the funds which the owner of the organization is putting. Now the point arises that which one of the following statements about bonds is not correct? Bonds is among the debt. Debt is what? Debt is actually a loan that has been taken, and this loan really affects our business badly. Now, the first point is bonds are debt instruments. Bonds are a part of net worth of an enterprise. A bond is issued for a specified period of time. A bond carries a specific rate of interest. It carries a specific rate of interest. These are again debt instruments. But do you know this be a part of net worth, everyone? Net worth is what? Net worth is if I ask you what kind of money do you possess? So when we talk about the net worth of an enterprise, in this case, it's gonna be the area of debt is to equity. In this case, it is going to be the net worth is related to pure equity. It has nothing to do with debt. So in this case, bonds are a part of net worth of an enterprise. The duration of a bond is the holding period for which the interest rate risk disappears, the period remaining for the maturity, the period for which the bond has been issued, or the gap between the two interest payments. What do you mean by the term duration, everyone? Duration is the duration basically means any kind of period. That is one particular thing. You know. Now, what they are talking about in this question, how do we define the term duration? Duration of a bond is what? It is related to the period for which the interest rate is there, duration of the bond is after which I would say that the period for which the interest rate risk disappears. The point is, in terms of duration of a bond, you will definitely receive interest during that period. Why? Because bond is basically the interest payment of a bond is compulsory payment. You cannot crib about the fact that pata I had to pay, but now I don't pay today. Maybe I'll pay tomorrow. Maybe I'll pay after day after tomorrow. No, you cannot. The due dates for the bonds are already set, and if you don't pay in time, the lenders have the right to receive money from you. That's one of the strongest points about the bonds. Okay. Now comes the next point. In this era, the answer is the holding period for which the interest rate risk disappears completely. Then when the required rate of return, market interest rate, is equal to the coupon rate, the value of the bond is less than its par value, more than its par value, equal to its par value, decided by its unexpired period. Acha, this point is the required rate of return. Required rate of return is equal to coupon rate. Coupon rate is basically known as interest rate. This is one of the terminologies of YTM. Interest rate is equal to coupon rate. When we talk about the coupon rate, when the required rate of return is equal to coupon rate. Required rate of return is what you want. If what you want is the same amount that you are getting in terms of interest, at this point of time, it would mean that it is equal to the par value. Why? Because what I wanted is what I'm exactly getting, right? The next point. Which one of the following statements is correct? Bonds can be issued only with call option. Bonds can be issued only with put option. Bonds can be issued with both call and put option. Bonds cannot be issued with put or call options. What do you mean by put and call options, everyone? Bonds which are puttable, callable, these are basically a situation where the company has when the company has the right to call people, come, we have money, we would like to pay you, that is call. Put option is where the investor has the right to come to the company and say that we want you to pay us before time. So that kind of thing is also available when the bonds are payable on demand. Anything that is payable on demand, there you have this option. In terms of bonds, you have both kind of options. You have callable as well as puttable bonds. So in this case, the bonds can be issued with both put and the call option. So in this case, the bonds can be issued with both put and the call option. Now, which one of the following statements is or are correct about zero coupon bonds? Acha, zero coupon means this is a bond which has no interest. Can I give someone 100 rupees as a loan and then I cannot ask for any interest rate back? Won't it be weird? It would be. So, zero coupon bonds pay no regular interest. Technically, they don't. That is why they are called zero coupon bonds. They are issued at a discount to par value. The bondholder receives a full principal amount on the redemption date, or all the above statements are correct. In actual, all of these are correct. The zero coupon bonds are basically issued at a deep discount. Matlab maybe it would be issued at 80 and they would be redeemed at 100. So technically, this 20 rupees is basically your interest. Okay, this is what we call as interest. So technically, all of the above statements are absolutely correct. What is the relationship between duration and the term to maturity? Duration is basically the time period for which the interest is received by you, and the time when you will receive the money is called maturity. So in this case, the question is saying that what is the relationship between the area of duration as well as the term of maturity? How do we look forward to this, everyone? In terms of this, duration is always equal to the term of maturity, duration is greater than the term of maturity, duration is less than the term of maturity, or duration and term of the maturity are unrelated. Acha, when we talk about the duration and the term of maturity, in this case, one particular thing is there, that is duration is always less than the term of maturity. You will always have to make sure that your term period for which you are putting it, the duration is always less than it. The payment should be made before time, na? Or at least in time. This is the point. Duration is less than the term of maturity. Before the bond becomes mature, that particular portion is called duration, time period for which it is due. You know, how does the frequency of the coupon payments affect the duration of a bond? Increases the in coupon frequency, increase duration, decrease in coupon frequency, increase duration. Now these kind of questions I was telling you, this is a tricky part for the examination. Why? Because we do not anticipate they can give questions like this. In the upcoming class, I'll discuss the MCQs which are related to the numericals. You'll be like, these are easy, ma'am. But the point is, this kind of question are very difficult in the examination, and you should anticipate they are putting these kind of questions, because both in May as well as in November, I saw these kind of questions being asked in the exam. So you should be very clear about what kind of questions are coming up and how do we look forward to it, right? So, okay, when we talk about increase in coupon frequency, increase duration, decrease in coupon frequency, increase duration, then coupon frequency has no impact on duration. नहीं, ऐसा नहीं है. Coupon frequency is interest rate. The duration of this particular point. See, decrease in coupon frequency. If I am if the interest rate and everything else is paid with a little delay there, you know, decrease in coupon frequency, if the frequency is constantly decreased, this will increase the duration for that particular bond, right? So duration is directly proportional to coupon frequency. No, the answer is B. The decrease in the coupon frequency, that is the portion of interest rate, it will always increase the portion of duration. So can I say frequency and duration have an inverse relationship? Not a direct relationship, they have an inverse relationship. These kind of questions should be anticipated in the examination, because this is an eye opener. For these questions, we should be very open and clear about it. You know, what is the relationship? These are out of the theorems of YTM, everyone. What is the relationship between duration and yield to maturity? Okay, duration is basically what? The time period for which that is due, and YTM is what? YTM is yield to maturity, whatever the yield, that is the ultimate income that you are getting. See, they are directly proportional, they're inversely proportional, or no interest rate between duration and YTM. Duration and YTM are always equal. In actual, your duration and YTM are inversely proportional. That means if your YTM is increasing, your duration will be decreasing. Vice versa, if you increase your duration, the YTM would be lesser. If you would have seen in terms of the long-term loans, the interest rate is less than that of the short-term ones, because in short-term you're in dire need, while in terms of long-term you are not. So technically, keeping these things in mind, they are inversely proportional, right? How is the market value different from face value or redemption value? Market value is always higher than the face value. Market value is same as redemption value. Market value may be different from face value or redemption value, or market value is always lower than the redemption value. We have something called market value. Market value is the value at which we can get it in the market. Face value is actually the value at which we purchase it. That is what at which we are issuing it. This is actually the book value. and redemption value is completely different, the value at which we are redeeming or making the payment to them. Technically, these can be extremely different because whatever the value there in the market is based upon demand and supply of those things, right? So when we talk about the demand of the bond is increasing, then obviously the market value of it will go higher or it will go lower depending upon the demand of that particular bond or the economic situation of the country or the market. So technically, keeping all these things in mind, you'll be standing in a situation where market value may be different from the face value or the redemption value. Okay, what is the purpose of day count conventions in bond markets? To determine the coupon rate, to calculate the face value, or to establish the market value of the bond, or to calculate interest payments based upon the number of days. Everyone, when we talk about day count, it is basically to calculate the interest payment based upon number of days. Done, everyone? So in this case, it's going to be D. Okay. The next question is to calculate interest payments based upon the number of days. When we talk about the day count convention in the bond market, technically, now, if we talk about the payments, the interest in some cases, if it is redeeming before time, then you will be given proportionate interest rate. Now, so when you're given interest rate according to the number of days, that is day count. You consider each and every day. So that means if they say 12% per annum, then it would be 1% per month, and 1% per month, matlab 1% divided by 30 days, and then you calculate it per day as well. So you need to know if you're holding the bond for a certain period, then what would it be? The bonds are also transferable, so people can also transfer these bonds. So technically, the investments here are now very much reflexible. You know? So here comes a bond which is called bearer bond, backed by the government assets, non-negotiable, registered by the number to prevent counterfeiting, an official certificate issued without a named holder. Acha, what do you mean by bearer person is clearly not stated. That is what we call it as bearer bond. You know, so bearer bond is the one where no name is stated. It has nothing to do with the backup of the government assets. If there is an asset backed up, it is basically based upon the um, registered ones. In this case, we are talking about they have secured debenture, secured bonds are the ones which have been backed up, and then we have registered non-negotiable, and non-negotiable are the ones which are non-transferable. वैसे तो they are all transferable in terms of bonds. And we talk about registered by the number of to prevent counterfeiting. With the point is, bearer bonds are very overall now they are very prone to frauds and all because there is no name written. The one who's holding it is the owner of it. So this is a little riskier bond, I would say. In this case, the answer is A. Sorry, D. An official certificate issued without the named holder. Acha, which option provides the issuer the right to repay the bond at the par or with the premium or on a specific call dates? Put option, callability, putability, callable option. They're talking about issuer the right to repay the bond. मतलब the company has the right to call the person कि ठीक है ना, you come and we will pay you. We have got good amount of money, we'll pay you in advance. So what will you do? In this case, the answer is callability. Bonds are callable as well as bonds are putable. Matlab in this case, if the investor had the right, in the opposite case, the sorry, in this case, the company had the right, and now investor also had the right. What is the result if a bond is referred to as putable or retractable? The bond has variable interest rate. The issuer can repay the bond at any time. The bond holder has the right to force the issuer to repay the bond before the maturity date, or the bond is backed by a mortgage security. No, when we talk about mortgage security, the secured ones, secured bonds. The bonds has variable rate of interest. Normally they don't. They have a specific interest rate which is already defined. So in this case, the answer is the bondholder has the right to force the issuer. See, investor when can go when investor has the right to ask the company to pay him to repay the amount he has invested right away. This is called putable. And when the company has the right to call the investor to make the payment, this is where they call it callable. Okay? Company has the right, then callable, and the person is asking for their right, he's putting it in on the desk. Na? These are putable. So that's the answer. Acha, what is the result if the bond is referred to as callable? The bond can be traded on stock exchange. It is for a fixed period. The issuer had the right to repay the bond before the maturity date or the bond is backed up. If we have done this question in a similar method, the answer is C, everyone. It just has to be paid before the maturity date. So this is it, everyone. Thank you so much for being there. We are done with this particular uh, area of the basics of YTM. Now, if you haven't subscribed to our channel yet, then please go ahead and subscribe the channel and download the app right away, because app is definitely helpful for you. And before I end my session, as I told you, the sale is going on, and if you haven't enrolled yourself in any of our courses, then go ahead and utilize this particular time for your benefit. This is our website, www.adda247.com. Go on to the area of JIB Mahapack, CIB Mahapack. This is where you will find JIB and CIB both. You will find only JIB Mahapack as well. At this point of time, it is available for 12 months. You have around 12 months where everything bilingual English medium, recorded live revision batches, current courses batches, all these things are opened for you. Test series opened up for you, ebooks opened up for you, mini marathon, maha marathon, doubt classes, everything is there. Matlab, you name it and you have everything in Mahapack. If you have taken the Mahapack, you don't even have to pay a single penny afterwards. Use the code Y541 and get 9, and you will get it for a lesser amount if you are using the app there. So go and utilize the app. This is our batch where you get English medium, three subjects, four out of four subjects, IE and FS, AFM, then RBWM, as well as PPB. This is our resolution batch. Currently, 80% discount is going on. It will end soon, so it's better that you avail it right away. And if you feel you want to take up only the AFM, only AFM is also available, everyone. Click on the area of buy now, then use the code Y541 and click on apply. You can get for 1574.79. It is available at 80% discount, so you can take it up. The validity is for 6 months. The batch has recently started. That means you won't miss much. Rather, you will not even miss the first chapter. It is still going on. So enroll yourself, get done with it, and I'll be meeting you in our regular sessions as well. Till then, if you find these sessions helpful, please go ahead and like it and share it among your peers. Thank you so much for being there, everyone, and happy Lodi, happy Bihu, as well as happy Pongal.